Retirement should be a time of relaxation and enjoyment, but for Vince and Mindy, it's become a puzzle of numbers and tax strategies. With a $500,000 corporate account and a combined $3.5 million in assets, they're facing a question many retirees dread: how do we unwind our wealth without losing it to taxes or government clawbacks? And this is the part most people miss: it's not just about how much you have, but how you withdraw it that can make or break your retirement dreams. Vince and Mindy, both 65, have just stepped into retirement with a mortgage-free home in Alberta, an adult daughter, and substantial savings. Vince, who ran a professional firm for over 15 years, admits, "I paid myself what I needed and left the rest in the corporation's account." Their initial plan was straightforward: draw dividends from the corporation until it's depleted, then rely on government benefits and their registered retirement savings plans, RRSPs. But here's where it gets controversial. They recently sold a rental property for $400,000, triggering capital gains tax. To avoid a double tax hit this year, they've decided to pause withdrawals from the corporate account, relying solely on the sale proceeds for 2025. Is this the smartest move? Or could they be missing a more tax-efficient strategy? Their primary concern? Minimizing taxes and avoiding the old age security, OAS, clawback while maintaining their inflation-adjusted standard of living. To tackle this, we turn to Matthew Ardrey, a senior financial planner at TriDelta Private Wealth in Toronto. With certifications in financial planning and a keen eye for detail, Ardrey dives into their portfolio, which includes $220,000 in tax-free savings accounts, TFSAs, $1.41 million in RRSPs, and $315,000 in a locked-in retirement account, LIRA. But here's the kicker: their corporate account, holding $500,000, is a ticking tax time bomb if not handled correctly. Ardrey's plan starts with a bold move: deferring Canada Pension Plan, CPP, and OAS benefits until age 70. This allows them to draw on other assets at a lower tax rate while increasing their future government benefits, he explains. Vince will also unlock his LIRA, splitting it 50-50 between his RRSP and a life income fund, LIF, from which he'll take the maximum withdrawal in 2026. Meanwhile, they'll withdraw $100,000 annually from the corporate account, split equally, to exhaust it before claiming CPP and OAS. But is this enough? Ardrey suggests consulting an accountant to explore untaxed balances in the corporation's capital dividend account or general rate income pool, which could further reduce their tax burden. And this is the part most people miss: their portfolio lacks diversification. With 30% in cash, 30% in Canadian stocks, and 40% in US stocks, they're missing out on international markets and bonds. Adding bonds or bond funds could boost overall returns, Ardrey notes. He also recommends expanding into European, Asian, and Far Eastern markets for better balance. Running a Monte Carlo simulation, a stress test for financial plans, Ardrey finds a 98% success rate for their retirement goals. Their 30% cash holdings act as a safety net during market downturns, he adds. As for the OAS clawback, there's only minimal risk, with Vince facing just $250 in 2029 and $1,600 in 2030. But should they settle for minimal when none is possible? Their monthly after-tax income? A comfortable $10,850, with expenses totaling $8,990. Yet, the real question lingers: are Vince and Mindy's moves bold enough, or are they leaving money on the table? What would you do in their shoes? Let's debate. Comment below with your thoughts on their strategy, and whether you'd take a more aggressive or conservative approach to unwinding such a substantial portfolio.